This is a scenario right now where a lot of folks are saying, hey, volumes are drying up here. Should I really be doing anything on this holiday shortened trading week? Is the market right now in a stable and balanced position in your mind?
I think for now, right, as you mentioned, a lot of data yet to come, and I think that can kind of have a big effect on where we go from here. But look, it's been as calm a period in the market as we've seen this year. You know, a lot of days over the last 10 days with less than a 1% range. So it's been a very calm period in the market as I think investors have gotten kind of comfortable with where we are, right, which is inflation high but decelerating, the Fed aggressive but potentially slowing, and earnings, you know, wrapping an earnings season that was uninspiring, but not, you know, fall out of the bed bad. So I do think the market is kind of comfortable with the position we're in now. But in this kind of volatile environment, you know, that can change day to day. So we'll watch the data today. We'll watch the inflation data over the next month before the Fed meeting and get a better handle on where we are into year end.
I mean, comfort and volatility are interesting words to use right now. I'm looking at the CBOE volatility index, the VIX. We don't often talk about it, but right now it's hovering right around 20, 21, 22 points. The reason why that's important was a month and a half ago, it was up at 33. This is an indicator of stock market volatility. That means volatility has pretty much collapsed in just the last 4 or 5 weeks. Does that signal anything to you about whether or not we could be due for another bout of downside volatility?
So this has actually been something interesting all year. The VIX, while you're right, it got up above 30 and it reflected some of the fear and anxiety, you know, in the investor base. It never spiked above 40, you know, above 50, which is something that we've seen in past periods of selling, like we saw this year. So 2020, 2008. I mean, you saw massive spikes in the VIX. You haven't seen that yet this year. So I think on one hand, it does reflect a bit of investor complacency, or at least a bit of that idea that capitulation hasn't fully happened yet. On the other hand, if you look at the same indexes for bonds and for currencies, they've spiked off the charts. So I do think that there is a piece of this where the volatility is being reflected in the other asset classes and not necessarily that investor anxiety being reflected in stocks, even though we were down 20, 25% at different points this year.
Ross, are there any key sectors or industries that you're looking at right now, given the fact that interest rates are still higher than they were a year ago, but certainly much lower than they were at the peaks earlier this year? Are valuations still a concern given those rates?
I think they probably are. At past market bottoms, you did see valuation kind of quite a bit lower actually than we're at right now. The couple of sectors that we're watching, I mean, on one hand, you got to watch consumer discretionary, comm services, and tech to get a better sense of how is that past leadership doing? How are those big behemoths of the past decade holding up in this new world that we're in? On the other hand, I want to watch energy closely heading into 2023. Energy is supposed to represent a big portion of earnings and growth for the index next year, to the extent that will exist at all. And oil continues to act poorly. It's moving lower. It's kind of waffling around, but not heading in the direction you want if you're an energy company. So we're watching that closely. They're making a lot of money right now, tremendous spreads. So I think there's still optimism, but we're watching energy closely to make sure that the positive side of the story in 2023 can hold up.